indicators are one of the most interesting topics when it comes to stock trading, because a lot of traders get fascinated and they get hyped up looking at indicators that this is that magic spell that they have got where they can make a lot of money from it. Now, this episode is going to break all that myth. It's going to break all that misassumptions, and we're going to learn about the right way of using indicators and how to categorize them. So let's get started. Now, as you can see, there are two types of indicators. One is called leading indicator, one is called lagging indicator. Let's go to the previous slide. What are indicators? Indicators are scripts or tools that does mathematical calculations which are plotted on a price chart and can help traders identify certain signals and trend within the market. There are different types of trading indicators, including leading and lagging indicator. Two major segments where we can divide them as leading and lagging. Now, indicators, I'm sure you would have understood by now, they are nothing but Python codes. They're nothing but programming language code that follows a proper mathematical formula to give you data, to give you signals or certain moments that can tell you that the price can go bullish or bearish from that point of time. Now, what are leading, what are lagging indicators? Leading indicators influence future performances. So it tells you that what can be the possible move in the future at a certain point in time. Whereas the lagging indicator, it analyzes the previous performances, the past performances. So it will understand the previous price movement of a certain stock or an index or any chart that you're talking about, and it will give you data where you can study the previous moments of the chart. Whereas the leading indicator will give you data about the future price movements. Lagging indicator will give you data of the previous price movement. I know it might be a bit confusing. Let's take some examples, then this entire process will be very clear to you. It's very easy. We'll move on to types of indicators. Now, there are three major types of indicators to consider, that is trend indicator, momentum indicator, and volatility indicator. Now, you can see the definitions. Let's just go through that to understand what it means. Trend indicators, these technical indicators measures the direction and strength of a trend by comparing prices to an established baseline like moving average or MACD. Now, the trend indicator helps you analyze how strong is a certain trend in the market. There are two types of trends, an uptrend or a downtrend. A third party is where it's a range bound market or a flat market condition. Now, these trend indicators helps you to understand if there's a bullish trend, is the bullish trend strong enough where you can enter into it for a long position? Similarly, if there's a bearish trend, is the bearish trend strong enough so you can enter into that? Moving average and MACD is a very good indicator that I personally recommend, and we will get into how to use them in the coming episode. Next is momentum indicator. Now, what exactly does that mean? These technical indicators may identify the speed of price movement by comparing the current closing price to the previous closing price. Now, these indicators like RSI or momentum RSI, these indicators have a mathematical formula where they're going to calculate the closing and the opening price of couple of previous days. Like RSI has a default of 14 days. Now they will give you an average move, an average number or an average graph on is the price being bullish in the last couple of days, or is the price being bearish in the last couple of days. So it's an average of the previous days that the market is going to the indicator is going to tell you. Now, how to use this is a main concept about these indicators. We will get into RSI in the next episode, in the couple of episodes. Next, volatility indicators. Now, these are something that I would not recommend to use, but we'll get into why so in some time. These indicators measure the rate of price movement regardless of direction. Now, whenever there is an uptrend, whenever there is a downtrend, does not matter. Volatility indicator tells you that how strong is that uptrend and how weak is that downtrend. Now, don't get confused between trend indicator and volatility indicator. They some or the other way have the same objective, to identify the trend in trend indicator and the strength, whereas in volatility it is more about strength. It is more about how powerful is that certain push in the market, right? Now, examples are Bollinger Bands and volumes. Now, volumes are something that I personally recommend because it's one of the most commonly used indicators in the market. Now, I am going to dedicate single sessions for all this indicator that's going to help you in the coming days, in the coming episodes, so that you can use it in the live market. I hope this episode was filled with new content for you. Let's move on to the next episode.